Good morning. This is Dr.S.VALLUVAN. Welcome to the teaching video of Common Size Income Statement. Before we get into the video, let's understand financial statement analysis. Financial statement analysis involves examining a company's financial statements to assess its performance and financial health. There are several methods and types of financial statement analysis, which can be broadly categorized as follows. Like horizontal analysis, it is otherwise called as trend analysis. In this analysis, financial statement of a company will be analyzed over the period of time. Say for example, last 5 years or last 10 years, like that. Each and every line item will be compared with the previous years, preceding previous years. So this is what we call a trend analysis. It shows whether the particular line item is an increased trend or in a decreased trend. That is what we call the trend analysis. And the another one is vertical analysis. It is a common size analysis. Base figure will be taken that will be compared with the other line items of the income statement or the balance sheet within the same year. Then the ratio analysis, different types of ratios will be working out, and it will be analyzed. Say for example, liquidity analysis, liquidity ratios, and solvency ratios, like that. Then fourth type is comparative financial analysis. Then fifth one is DuPont analysis. Then cash flow analysis, funds flow analysis, segment analysis, quality of earnings analysis, benchmarking. So we'll be looking at as we go along, one by one. The first one is horizontal analysis. As we looked at earlier, the definition of horizontal analysis. This method involves comparing financial data over several periods to identify the trend and patterns. It helps to analyze the growth and performance trends over the period, that is over the time, like last 5 years, like that. Example, from the year 21 to 23, to see whether the company's profitability is growing or declining or staying constant. Then the vertical analysis. Vertical analysis expresses each item in the financial statement as a percentage of a base figure. Say for example, total revenue is a base figure we want to take to analyze the each and every line item of the income statement. In a balance sheet, the base figure will be total assets. Then purpose, useful for comparing the financial statement of companies of different sizes and for analyzing the relative proportions of different components. Expressing each expenses as a percentage of the total sales to understand the cost structure. Ratio analysis, it involves calculating financial ratios to assess different aspects of a company's performance, including liquidity, profitability, and solvency. It helps stakeholders make judgment about financial health of the company. When you say stakeholders, those who are having a financially interest in the company, they're called stakeholders, like customers, suppliers, government, income tax department, creditors, they're called stakeholders. In ratios, different types of ratios are there, like liquidity ratios, profitability ratios, leverage ratios, leverage in the sense of solvency ratios, then efficiency ratios. Then comparative financial analysis. This method compares a company's financial statement with those of its competitors and industry benchmarks. It helps in understanding how a company performs comparison to peers. Comparing profit margins of a company with those of the industry average to gauge competitive standing. Then move to DuPont analysis. It is a method that breaks down return on equity onto its components. Generally, when we interpret the return on equity, if it increasing, it shows increased trend, means that is good for the company. But in a DuPont analysis, we'll be analyzing the return on equity, which factor influencing the ROE to move. Say for example, if the return on equity is increasing over the period, so we want to analyze which factor causes return on equity to increase or decrease. There are three components. One is profit margins, another one is asset turnover, and third one is financial leverage, that is debt. So it is very important for the financial analyst or the financial manager or CFO to look into the factors like operational efficiency and asset use efficiency and the debt. Among these three factors, which factors causes the ROE to increase or decrease? If the factors of operating efficiency, that is profit margins, or asset use efficiency causing the ROE to increase, means that's okay, that's good, fine. But the debt fund, that is financial leverage, causes ROE to increase, means that's not good for the company. So in this way, to get the reason behind that, we are using the DuPont analysis to know which factor causing the ROE to increase or decrease.